But I think what the markets were looking at is the cuts that come later. And I think the interpretation, the misinterpretation of the economic data that came out this week was that, oh, the economy is stronger, and so maybe we won't get as many rate cuts. And I think that's what boosted the dollar. That's what weighed on gold. But if you actually understand the economic data, it was all bad. It's all a weak economy with higher inflation. It's stagflation. It's bad economic news. But so many traders just have no understanding of basic economics. And so that's why in the short run, the markets do the opposite maybe of what they should be doing.
Gold has recently hovered above the $2,500 mark, a key level traders watch closely for its psychological significance. This threshold is often seen as a signal of gold's strength and suggests that the metal could continue its bullish run throughout the year. However, speculators have raised concerns that the optimism surrounding gold's future, particularly driven by expectations of Federal Reserve rate cuts, might be misplaced. If the Fed's actions fall short of these high hopes, we could see a downturn in gold prices. Peter Schiff highlights the recent fluctuations in the gold market, noting a minor pullback where prices closed just above $2,500, marking a decrease of about 1/3% from the previous week. Despite this slight dip, gold stocks experienced a sharper decline, with the GDX falling nearly 2% and the GDXJ dropping close to 4%. This sharp drop in gold stocks reflects the nervous sentiment among traders, who remain highly skeptical and quick to react to even minor price weaknesses. This market behavior underscores a broader confusion among investors, who seem to be misinterpreting economic signals. There is a tendency to view signs of economic weakness, such as persistent inflation and stagnation, as resilience indicators. This confusion has contributed to a stronger dollar and a temporary dip in gold prices. Yet the reality of a struggling economy combined with high inflation suggests that the market will eventually correct itself to align with these underlying economic conditions. As these economic realities become clearer, a market correction is likely. Peter suggests that investors who understand the broader economic trends and navigate the current uncertainty strategically will be better positioned to benefit from this misalignment. By preparing for the inevitable market adjustment, these savvy investors can capitalize on the eventual realignment of prices with the true economic fundamentals. This period of market confusion presents a valuable opportunity for those who can anticipate and act on the upcoming correction. Please tune in for our exploration of Peter Schiff's expert analysis. Don't miss out on future content. Hit the subscribe button and turn on notifications to stay in the loop. We appreciate your support.
Because of the misperception, we did have a pullback in the price of gold, although minimal. In fact, gold closed over 2,500. So the pullback was about maybe 1/3% from where we were a week ago. But despite that very minor decline in the price of gold, gold stocks got hit pretty hard. The GDX was almost down 2%, and the GDXJ was almost down 4% on a nothing move down. That's how nervous these gold stock traders are. I mean, there's no optimism. I mean, not even close to euphoria. They are very skeptical. And the minute they see the price of gold go down, even slightly, they're like dumping their gold stocks. And the reason that the GDX wasn't down more was because Newmont kept hitting new 52-week highs. Because somebody finally upgraded Newmont to a buy. I forget the firm that upgraded it. But I talked earlier this year when Newmont got downgraded to a sell. And I was buying more Newmont. Even though I have a huge position in Newmont, I had to buy that downgrade because I thought it was so ridiculous. So finally, it got upgraded to a buy. But I thought the interesting part about the upgrade was the price target was only about 10% above the current price, which is ridiculous. I mean, why even bother to buy it if you think you only got 10% upside? I mean, they waited for the stock to move up dramatically. I don't know what is 60, 80% from the lows to say buy it for the next 10%. I mean, the price target is ridiculously low compared to where I think it's going to go. But I think Newmont getting that upgrade, and it kept hitting new 52-week highs, that's what propped up the GDX. Newmont's not in the GDXJ, which is why it was down closer to 4%. But neither of these indexes should have been down. They should have been up. It doesn't matter that gold prices are down. They're still above 2,500. These gold stocks are priced for gold to be much lower than 2,500 because none of the gold stock investors even believe that gold could get to 2,500. And that's why they think it's not going to stay at 2,500. They're right about that because it's going much higher than 2,500. Also, the dollar index bounced back a little bit on the week, again, based on the misinterpretation of the data that came out during the week. I think the traders looked at this data as meaning, well, maybe the Fed is not going to cut rates as much as we thought. I mean, it's pretty much baked in the cake. They're going to cut in September of August, but so the September meeting is coming up. And I think there's no way the Fed's not going to cut. But I think what the markets were looking at is the cuts that come later. And I think the interpretation, the misinterpretation of the economic data that came out this week was that, oh, the economy is stronger, and so maybe we won't get as many rate cuts. And I think that's what boosted the dollar. That's what, weighed on gold. But if you actually understand the economic data, it was all bad. It's all a weak economy with higher inflation. It's stagflation. It's bad economic news. But so many traders just have no understanding of basic economics. And so that's why in the short run, the markets do the opposite maybe of what they should be doing. But in the long run, the economic fundamentals are going to be borne out. And the markets are going to do what they should do. And that's going to confound the people who don't understand the economics. The people who do listen have a much better understanding of what's actually going on. And so that, we can position our investments to profit from the inevitable realignment where the markets move to reflect the underlying economic fundamentals.
On Friday, the Federal Reserve's key inflation gauge, the Personal Consumption Expenditures (PCE) price index, showed a steady 2.5% increase for the year ending in July. This matched economists' forecasts and was consistent with the previous month's figure. Although the Fed aims for a 2% inflation rate, the persistent level of 2.5% highlights ongoing inflation pressures. The core PCE index, excluding food and energy prices, rose by 0.2% from the previous month, aligning with expectations. Its annual rate remained at 2.6%, slightly better than the projected 2.7%, but still above the Fed's target. Despite this, the Fed seems set to cut interest rates next month, which appears contradictory given their past stance when inflation was below 2%. At that time, the Fed employed aggressive monetary policies and zero interest rates to stimulate the economy. Even with inflation above target, the Fed's current inclination to lower rates suggests that its primary concern may be the high debt levels and the government's struggle with current interest rates rather than managing inflation. Market expectations of Fed rate cuts have restrained long-term interest rates, reinforcing the Fed's likely approach.
If you look at the inflation numbers, because the Fed, apparently the Fed likes these numbers, right? These are the numbers they like more than the CPI, right? This is the core PCE, the year-over-year PCE. That stands for Personal Consumption Expenditure. And the reason the Fed likes this number the best is because it's the least accurate. But it's not just the least accurate in that sometimes it's too high, it's always too low. Like whatever the CPI is, this number is going to be lower. And that's why the Fed likes it, right? Because it makes their job easier, because it makes it easier to pretend that inflation is lower than it actually is. And the reason is because of all the substitution and the hedonics. There's a lot more manipulation that goes into the PCE to artificially lower the number. I mean, you got that in the CPI too. So all the government numbers that purport to measure inflation understate inflation. But the PCE understates it the most. That's why it's the Fed's favorite measure. And so that the number was supposed to come out, the month-over-month number was supposed to be up 0.2. And that's, in fact, exactly what it was. It was up 0.2. The year-over-year number was supposed to be up 2.5, and it was up 2.5. So exactly as expected. The only good news, right, was the core PCE, not even month over month, because that rose 0.2, which was in line with the expectation. But the year-over-year core, which was supposed to go up to 2.7, stayed at 2.6, which is where it was the month before. But if you look at this number at 2.6, this is the Fed's favorite way to measure inflation because it's, the most understated. But even this number is 2.6. 2.6 is not 2. In fact, 2.6 is as far away from 2 on the upside as 1.4 was on the downside. Now, what was the Fed doing when inflation was 1.4? Not that it was even there very long. Well, they had the monetary pedal to the metal, right? They had quantitative easing and 0% interest rates. We were so far away from 2% inflation that we needed QE and 0% interest rates to get the rate to go up to 2%. Well, now we're symmetrically as much above 2% as we were below, and apparently the Fed can cut rates. Why? There is no indication in any of this data that we got this week that inflation is anywhere closer to 2% than it was 3 months ago, 6 months ago, 9 months ago, a year ago, when the Fed said, hey, we can't cut rates. We need more data. We're data dependent. We want proof that inflation is coming down. Well, they have no proof. Yet they're prepared to cut interest rates anyway. Why is the Fed going to cut rates? It's not because inflation is coming down to 2%, because it's not. It's because the economy is too indebted to handle the rates where they are right now.
Gold's peak of $2,529 this week establishes a crucial level that could signal a potential breakout to the upside. The current consolidation phase indicates a period of stabilization, but gold's position above the midpoint of the month's trading range suggests a bullish trend. While not the strongest bullish signal, it still points to positive momentum for the remainder of the month. Share your thoughts on Peter's prediction in the comments section below. Also, ensure you like this video, subscribe to the channel, and turn on post notifications for more videos like this. Until next time.